Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to show you a compilation I have made from Charlie Munger's discussion with shareholders in the daily journal shareholders meeting. I have done a compilation. Charlie Munger is the vice chairman of Berkshire and the partner of Warren Buffett, both of whom I have been following for a long time. So I want to share with you his views of investing and of the world in general. So let's go and see it.
Value investing, the way I regard it, will never go out of style, because value investing, the way I conceive it, is always wanting to get more value than you pay for when you buy a stock. And that approach will never go out of style. Some people think that value investing is you chase companies which have a lot of cash and earn a lousy business or something. But I don't define that as value investing. I think all good investing is value investing. It's just that some people look for values in strong companies and some look for values in weak companies. But every value investor tries to get more value than he pays for. What is interesting is that in wealth management, a lot of people think that if they have 100 stocks, they're investing more professionally than they are if they have 4 or 5. I regard this as insanity, absolute insanity. I find it much easier to find 4 or 5 investments where I have a pretty reasonable chance of being right that they're way above average. I think it's much easier to find 5 than it is to find 100. I think the people who argue for all this diversification, by the way, I call it de-worsification, and which I copied from somebody, and I'm way more comfortable owning 2 or 3 stocks which I think I know something about and where I think I have an advantage.
Could you provide your systems for selling securities?
Well, I so rarely hold a company like BYD that goes to a nosebleed price that I don't think I've got a system yet. And so I'm just learning as I go along. I think you can count on the fact that if we really like the company and like the management, and that is the way we feel about BYD, we're likely to be a little too loyal. And I don't think we'll change on that.
So the key points from this section: value investing. All investing is value. Value investing is a redundancy, like saying a free gift. All investing is value, because what you're doing when you're investing is trying to get more value than what you put in. And if you see, that's also the definition of speculation, in essence, because the moment you can't define what value is of where you are investing or betting, then that means that you are speculating. The other thing he talks about, it's interesting, is about diversification. You don't need to over-diversify. If you're buying 100 companies, it's good because you're going to have average returns, and your mistakes are going to be cancelled out with your successes. But the problem with that is that you have to, if you're doing it the way he's doing it, which is analyzing companies, you will have to follow 100 companies. For him, it's easier to find 5, 6 good companies that he knows where he has a competitive advantage, to understand them and to understand the value that he can get from them, rather than 100. And in fact, if you see the daily news portfolio, it has not more than 5 stocks. So for him, it's much better to really understand the business where you're investing, rather than spread all your investments into hundreds of stocks, which of course will be like an insurance policy for not knowing what you're doing, in essence. About selling, he's still learning, and this is great because he's 90 years old or something like that, and he's still learning, and he hasn't yet figured out a system for selling. But he and Buffett both tend to not sell any business for price reasons, if the business still meets their quality requirements. like management, and the good business. In this second section, Charlie Munger discusses about booms, busts, free trading or free commission trading, momentum trading, gambling, SPACs, and timing the market. So let's watch it.
Well, these things do happen in a market economy. You get crazy booms. Remember the dot-com boom, when every little building in Silicon Valley rented at a huge price, and a few months later, they were about a third of them were vacant. There are these periods in capitalism, and I've been around for a long time, and my policy has always been to just ride them out. In fact, what shareholders actually do is a lot of them crowd in to buying stocks on frenzy, frequently on credit, because they see that they're going up. And of course, that's a very dangerous way to invest. That's the kind of thing that can happen when you get a whole lot of people who are using liquid stock markets to gamble the way they would in betting on racehorses. And that's what we have going in the stock market. And the frenzy is fed by people who are getting commissions and other revenues out of this new bunch of gamblers. And of course, when things get extreme, you have things like that short squeeze. It's not generally noticed by the public, but clearinghouses clear all these trades. And when things get as crazy as they were in the event you're talking about, there are threats of clearinghouse failure. So it gets very dangerous. And it's really stupid to have a culture which encourages as much gambling in stocks by people who have the mindset of racetrack bettors. And of course it's going to create trouble, as it did. And I have a very simple idea on this subject. I think you should try and make your money in this world by selling other people things that are good for them. And if you're selling them gambling services where you rake profits off the top, like many of these new brokers who specialize in luring the gamblers in, I think it's a dirty way to make money, and I think that we're crazy to allow it. Robinhood trades are not free. When you pay for order flow, you're probably charging your customers more and pretending to be free. It's a very dishonorable, low-grade way to talk.
What do you think of all of the SPACs and the promoters pushing them?
Well, I don't participate at all, and I think the world would be better off without them. I think this kind of crazy speculation in enterprises not even found or picked out yet is a sign of an irritating bubble. It's just that the investment banking profession will sell shit as long as shit can be sold.
Many observers see market behavior that reminds them of the dot-com bubble, wild speculation, endless SPACs and IPOs soaring on their first day of trading. Do you agree that there is a close parallel to the late 90s and this is therefore, quote, must end badly?
Yes, I think it must end badly, but I don't know when. Well, it's most egregious in the momentum trading by novice investors lured in by new types of brokerage operation like Robinhood. And I think all of this activity is regrettable. I think civilization would do better without it. You'll remember that when the first big bubble came, which was the South Sea bubble in England back in the 1700s, it created such havoc eventually when it blew up that England didn't allow hardly any public trading in securities of any companies for decades thereafter. It just created the most unholy mess. So human greed and the aggression of the brokerage community creates these bubbles from time to time. And I think wise people just stay out of them.
The main takeout for me, a couple of takeouts from me are, the first one is that he's gone through many booms and busts in the stock market. He has quite a history. He has quite an experience. And his strategy is to write them out. meaning just to wait until they pass. The other part I like is when he's asked whether this must end badly. And he's talking about speculation, not generally in the market as a whole, but in specific, I think, spots in the market. And he answers, well, yes, it must end badly, but I don't know when. And there you can see that what he's saying is it's impossible to time the market. Nobody can do it. So don't try. In this third section, he talks about Tesla, Bitcoin, and gold. Let's watch it.
I do think that a properly run bank is a great contributor to civilization, and that the central banks of the world like controlling their own banking system and their own money supplies. So I don't think Bitcoin is going to end up the medium of exchange for the world. It's too volatile to serve well as a medium of exchange. And it's really kind of an artificial substitute for gold. And since I never buy any gold, I never buy any Bitcoin. And I recommend that other people follow my practice. Bitcoin reminds me of what Oscar Wilde said about fox hunting. He said it was the pursuit of the uneatable by the unspeakable.
Which do you think is crazier? Bitcoin at 50,000 or Tesla's fully diluted enterprise value of 1 trillion?
Well, I have the same difficulty that Samuel Johnson once had when he got a similar question. And he said, I can't decide the order of precedency between a flea and a louse. I don't know which is worse.
So the main takeouts I see here are really connected with the first section, which was about value investing. And you can see here that he's applying value investing into his views of Bitcoin, of gold, and of Tesla. In essence, Tesla, you can calculate the value, but in his view, the value of Tesla is not higher than the price he's putting in. In the case of Bitcoin, he doesn't see any value. He cannot calculate any value because it can't have any value for as a mean of exchange. It's too volatile, and you cannot use it for any other thing. So, and gold is the same thing. In this fourth and last section, he talks about interest rates, high multiple valuation in companies, inflation, and biology. So let's watch it.
We prefer owning common stocks to holding cash under current conditions. And it's kind of an accident that we have so much in marketable securities. Well, no, I don't think we have a bubble in Treasury securities. I think they're a bad investment when interest rates are this low, and I never buy any, neither the Daily Journal. Well, I think everybody is willing to hold stocks at higher price earnings multiples when interest rates are as low as they are now. And so I don't think it's necessarily crazy that good companies sell at way higher multiples than they used to. On the other hand, as you say, I didn't get rich by buying stocks at high price earnings multiples in the midst of crazy speculative booms. And I'm not going to change. I am more willing to hold stocks at high multiples than I would be if interest rates were a lot lower. Everybody is. So far, the evidence would be that maybe the modern monetary theory is right. Put me down as skeptical. Business success long-term is a lot like biology. And in biology, what happens is the individuals all die, and eventually so do all the species. And capitalism is almost as brutal as that. Think of what's died in my lifetime. Just think of the things that were once prosperous that are now in failure or gone. Whoever dreamed when I was young that Kodak and General Motors would go bankrupt? That's the nature of capitalism. It's like evolution in biology. New species are created and old species are dying. And of course, it's hard to negotiate in such a field.
my main takeaway here is that he doesn't see the market really overvalued, because he says that interest rates are so low that it is not crazy to pay higher price earnings multiples for different companies. But he mentions that he didn't become rich by investing in highly priced companies in crazy speculative booms. But I don't think we have a crazy speculative boom now. And I think that some companies with high price earnings, you still get value from those investments. Because interest rates are so low, investing in treasuries is not a good business. And in fact, he is not investing in treasuries or in bonds, and neither the Daily Journal. That's also an interesting view of everything goes back to the first section where he talks about value investing, and in essence he's not investing in treasury bonds, because treasury bonds he can calculate the value, and the value is below the price that you're paying. Because if you invest today in low interest rates world, if you invest in treasuries, you're not even getting paid to cover inflation. So I think that it's quite consistent if you think about it. Everything that he has talked about in this section is mainly we can all summarize. So he's quite consistent, I think, even though you think that he's talking about different things. Everything can be summarized in the definition of value investing, or investing in essence. And his first few comments of this video that I've made. So, well, I hope that you like it. I hope that if you didn't know Mr. Munger, you now have a better idea of who he is. There's heaps of books and interviews and things to read from him, and letters, shareholder letters in the Daily Journal. I encourage you to get to know this person and learn from him. Probably not 100% of what he says, but he is a very good thinker. And I'm going to make a second video with more with content related more to life and other general principles about investing and about life in general. So stay tuned, and don't forget to subscribe and touch that alert button so you can get notified when I upload a new video. In this case, in a couple of days, I'm going to upload this second portion of Charlie Munger's interview. And well, thanks very much for watching.